Michael Burry's biography and investment approach. Who is Michael Burry? Michael Burry was born in San Jose, California, on June 19, 1971. He is a physician, hedge fund manager, and investor from the United States. He attended UCLA for his pre-medical studies in economics and medicine, and Vanderbilt University School of Medicine in Tennessee for his medical training. Burry was often uncomfortable and antisocial because he had Asperger's syndrome. Even though he was an expert at segmenting the market, he had few friends and was not widely recognized in the financial community when he first began his career. Among the first investors to predict and profit from the U.S. subprime mortgage crisis, which occurred between 2008 and 2010. Additionally, he is the investor that made a last-year wager against Elon Musk and Cathie Wood's ARK Innovation Fund. Instead, Michael Burry bought shares of GameStop, a stock that has become a meme. While obtaining his medical degree, Burry discovered a liking for stock trading. He studied economics and investigated value investing strategies in his free time. Burry had altered his mind by the year 2000 and thought a career in finance would be more appealing than one in medical. He left Stanford before completing his residency as a result. As an alternative, he established Scion Capital, where his investments were successful. Scion generated an AUM of $600 million by 2004, following a first-year return of 55%. In 2005, Burry extended an invitation to his investors to join him in a significant bet against the housing market. Unfortunately, it took a while for Michael's predictions to come true. He made the decision to bet against the U.S. home market in 2005 after learning that the mortgages sustaining it were unstable. He predicted that default rates would rise to 8% in 2007, at which point the majority of borrowers may find themselves unable to fulfill their mortgage payments. In order to set up credit default swaps on mortgages that would pay him if the underlying bond failed, he approached major banks. These CDS are simply contracts for insurance with monthly premium payments. He had a total short position of $1.3 billion. When market conditions worsened, the swap's market value climbed. Additionally, very significant premiums were paid for the short positions. Banks sought to sell their CDOs, therefore they resisted making the payments. Uninformed customers' subprime mortgages wouldn't be discounted until they were completely removed off the books. When the housing market collapsed, the value of his hedge fund increased by more than 48%. Michael Burry's trading strategy. As a conservative, Burry tries to separate his investments from the state of the market by putting little to no restrictions on them. Whether he invests in small cap, mid cap, tech, or non-tech stocks is immaterial. He seeks for the good in each of them. He contends that investments in undervalued economic sectors yield the best returns. He believes that by claiming that there was a significant lot of uncertainty about the direction of the market at the time, he will be proven correct. He yet maintains that the market perception is not one of caution. He would prefer to remain secure in the knowledge that widely held predictions are less likely to come true than is generally believed, since irrational individual stock values will occasionally arise regardless of what the market does. In order to choose which investment opportunities to pursue, he uses the ratio of enterprise value to earnings before interest, taxes, depreciation, and loss, which varies by industry and the stage of the business cycle. To avoid being duped by a company's claimed KPIs, he avoids price-to-earnings ratios. Instead, he carefully takes into account free cash flow from operations and off-balance sheet variables. Burry distinguishes himself from investors who prioritize value by seizing new opportunities as soon as they arise. For instance, he will make investments in asset plays, arbitrage chances, and companies that are being offered for less than two-thirds of their true value. Like Warren Buffett, he invests in companies that have a sustainable competitive advantage, presuming they are competitively priced and that Burry understands the company's operations. This might include IT companies. He considers them long-term investments because they are frequently hard to come by. Advice from Michael Burry for beginners. Michael Burry doesn't do podcasts or Q&As, and he never gives interviews. People are eager to learn about and follow Michael Burry, particularly those who are just getting started. They also want to know his opinions on stock market trading. Many traders were still able to covertly follow his ideas on the stock market through his Twitter presence throughout 2020 and 2021. Burry continues to tweet through his Twitter account, providing market forecasts and ideas. If you are unfamiliar with the stock market and want to learn more, his comments and analyses may be helpful. Burry thinks the U.S. stock market is booming at the moment. He recognizes significant overvaluation, though, and isn't hesitant to point it out. Burry's trading strategy was built on value investing, which is extensively described in the 1934 book Security Analysis by Benjamin Graham and David Dodd. He gives preference to agricultural land that is close to water and is not severely confined by political or physical restrictions. He declares at the conclusion of The Big Short that he will only invest in water moving forward, but this turned out to be untrue when he reopened Cyan Asset Management. Burry is making an investment in an increasingly popular nut that requires 5 liters of water per seed to grow. In California, where 80% of the almonds in the world are grown, they use 10% of the agricultural water that is available. Almonds should thus be grown outside of drought-affected areas and shipped home since it makes sense and is practical to do so. Burry uses research as a stock-picking tool. It is evident from reading through Burry's earlier blog posts how much time he invested in researching potential investments. Burry constantly performed in-depth assessments of his investments, looking for value everywhere. In contrast to other well-known value investors who prioritize the fundamentals with little regard for technical analysis or chart movements, he preferred to use technical considerations to arrange his buys and included a stop-loss. And last, Burry preferred to maintain a portfolio of no more than 20 reasonably targeted holdings. For most investors, this level of concentration is unwise, but Burry's in-depth research made sure he was informed about his holdings and comfortable with his decision to be so focused. Additionally, he had a high turnover rate. Please subscribe for more investing videos.